You want to know, what are the best stocks to buy now? You asked me to make this video, and I've been on the sidelines for a little while, but I've been buying stocks, and I want to share them with you. Is Tesla a car company or a technology company?
What was so interesting about the report was that they really were trying to define the company as an EV automobile maker. Is that the way you think about this company?
I think about it as a technology company that's providing services to their own company and to others. They can't possibly be matched by anyone else.
So if Tesla can't be matched by anyone else, and it's a technology company, it should make things pretty simple in terms of valuation, right? Well, not so fast. And this is the problem. And even the people watching this video, you're either going to classify this as a car company or a technology company. The problem is actually the AI revolution itself. Now that sounds counterintuitive, right? Well, Tesla has no way currently to monetize artificial intelligence, but will it in the future? And more importantly, if you're watching this, are you investing for the short term or the long term?
Yeah, I mean, if you listen to the earnings call, it was pretty much spelled it out, right? You have to look at this as a multi-decade thesis, right? This is a long-term play. Read the Walter Isaacson book. You'll really get a sense of how Elon thinks and what this future looks like, right? So the Model 3, Model Y, these are saturated brands largely. There's still going to be some growth. I think consensus has 14% growth in 2024. That's still significantly off the 40% growth that they did in 2023. But when you have the affordable car coming out in 2026, that's going to cost only $20,000
what
to
makes
make
you
it.
think that's coming out in 2026?
I mean, that is the plan, right? The start of production.
Well,
the end
no
of
plan has ever worked on time. We all know this. I've been in Tesla for 10 years. Okay. No plan has ever been on time.
So let's say it's not 2026. Let's say it's 2027, right? Let's look at the stock from a tectonic period from 2040 and then discount the cash flows back. My price target actually has 80% of the value in autonomy, right? My car business is only something like,
how
less
do you know
than 10%
Elon's going to
of the
be
value.
alive in 2040? I'm 53. I'm the same age as Elon. Like, when you talk multi-decades, we got to be around for this,
I think everybody would agree that there is a story there for autonomy, for artificial intelligence, for Optimus. But in the short term, there are a lot of headwinds, and not everybody is investing for the long term.
They have data, technology. They make cars cheaper than it was when Ford makes one of these cars, an electric car. Every car they make, they lose $36,000 on. $36,000 per car. Our company now makes about $8,000 or $9,000 in profit a car. They were making $15,000 in profit a car. But if they build a plant that costs $7 billion for 1 million cars, that plant was making $15 billion a year on a $7 billion investment. $15 billion on a $7 billion investment. An ordinary industrial company would make 15% on capital, 20% the most. This guy's making his capital twice a year. Now he's making it once a year. He's making $8 billion in a $7 billion plant. So he's the lowest cost person. Everything about the business is trying to drive prices lower.
So driving prices lower, but that's part of the problem, right? Margins have compressed. That used to be what gave Tesla the edge. That was the differentiator. And those margins are not what they used to be.
In the 1900s, early 1900s, the automobile companies were tremendous innovators. No longer is the case. In the 1950s, they decided they were going to go for profitability, and they outsourced all of their supply chain to their detriment. And all these companies went bankrupt. Hundreds of them went bankrupt.
Now, a $25,000 car, if and when it happens, there's no question, even if you're a bear, that will move the needle for Tesla. The stock will rip much higher, but that's not anytime soon.
But he's going to open plants all around the world for low-cost cars. And wait till you see what's going to happen when all of a sudden they start selling cars instead of for $40,000 a piece, for $25,000 a piece, which is going to happen in about a year and a half. From their new model. The new model, they think, is going to do 5 million cars a year. 5 million cars a year for the Model 2. That's coming.
Here's the bottom line on Tesla. We can talk about China demand being down, and I could explain to you that the Chinese New Year fell in a different time, and there are explanations there. For me personally, I look at this as a long-term investment. I'm thinking 2030 and beyond. And when I look at a stock, I'm trying to buy and hold, and I'm trying to buy reasonable levels and dollar cost average. So for me, I added some today, $175 or less DCA. All right, time for a mystery chart. Can you tell me what this stock is? So this stock went public September 22nd, 2023 at $33.39 a share. And it's trading today. It closed at exactly $25. Back in November of 2023, the stock got to $25.30. So we're at the lowest it's been since it went public, and that lockup period just expired. Have you guessed the stock yet? So Klaviyo can be broken down into two layers, and you can see on your screen. So there's going to be a data layer and an application layer. So this is software as a service, SaaS, and it's marketing automation. To explain this in simple terms, think of the data layer as all the information, and that includes the AI capabilities. The application layer is going to be used to take that data and make actionable results from it. So this platform is really about taking customer data and making use of it for marketing purposes. So you can see at the top, email, SMS, and mobile push. So you're talking about emails and texts. Klaviyo's AI tools are going to make it simpler for businesses to connect to their customers. So smarter insights, smarter decisions, and better results. And the company slide deck really drives home AI. You of course have to be a little bit careful with that because every company is talking about AI now. But this company, Klaviyo, does have AI at its core. Here's that flywheel that we love to show in Fired Up Wealth, and you can take a look. This is a rapid fire video, so I'm going to get right into some financials and talk about the price target. But before we get into that, I want to share the ownership because I think this is really important. And somebody was asking me earlier today, how come we don't see a ton of volume right now with this lockup? Now, one thing to note is Shopify is going to be 11.2% ownership. Shopify really is going to be critical for the success of this business. In fact, that's probably the primary risk, is there's just a lot of exposure to Shopify. But the CEO's got about 38% and the CFO's got 13.9%. And then you're talking really about institutional investors. If you look at other investors, insiders, and employees, only 5.4%. This IPO was unique because it came out when the market really wasn't all that hot for IPOs, and it was a rare SaaS opportunity with profitability metrics. Now with SaaS, software as a service recurring revenue, we like to look at EV NCM revenue and compare that to its peers. And currently at 8.3x. And then that LTM rule of 40 is 55%. So these are solid numbers. Now I did some analysis today and I compared it to its peers. I think that the fair valuation, if you're trying to put an EV NTM revenue, is between 10 and 12. So this has somewhere between 20 and 50% upside, in my opinion, over the next 12 months. Now I'm not a financial advisor and I could be wrong, and I'm investing in this long term. So I'm thinking several years. So I'm buying $25 or less DCA. This next stock pick is what we call a spec stock or speculative stock. These are companies that are burning cash. They're not profitable, but you're looking at the qualitative and the quantitative analysis, and that qualitative analysis has a strong story for future growth. Now, because these are speculative investments, they're what we like to say 10x or zero. Literally, these could go out of business or you could make 1,000% return. So we generally will teach to have 10% or less in a blueprint when you build a portfolio, and then have several stocks to kind of hedge that risk. Now, if you're in our Discord community, you know about this one. This is a small cap semiconductor company. And, you know, they're talking here about a $1 trillion opportunity, and this is a pretty small cap. As of right now, the market cap is $949 million, so less than $1 billion. And this is another one of those long-term stories. Read that right there, 24-year opportunity. I'm not suggesting you have to hold it 24 years necessarily, but understand if you're buying this stock, it's going to be one that's going to take time. You're probably going to want to hold something like this 5 or more years. If you look at the pie chart, you can see electric vehicles is in the blue, and that's going to be the major opportunity. But there are other exciting areas. When you think of secular growth trends and trying to capitalize on those, make money in your portfolio, make money in the stock market off of those secular trends, those mega trends, semiconductors, the new oil, are an excellent pick and shovel play. And since I've owned the larger cap semiconductor companies that are more popular, that have ripped, like the AMDs, the NVIDIAs, the Broadcoms, you get the idea. I look at these small cap semiconductor stocks as opportunities, but only if you have that long-term mindset. Navitas just recently reported earnings. You can see non-GAAP EPS, -4 cents, but it did beat by 1 cent. Revenue, $26.06 million. This is a small company. 111% year-over-year growth, and it did beat by 0.67 million. That forward revenue growth, about 75%, so slowing down a little bit. If you look at this pie chart, I think there's opportunity for all these areas to grow, but I'm especially excited about the EV, electric vehicle space, and data center. EV to sales, 10.24. Price to sales, 8.46. So it's not dirt cheap by any means. And here are the profitability metrics. You can see that the company has a long ways to go. Looking at a chart really quick, this is a previous chart day in orange. But if you look at this blue trend line, I generally like to buy stocks when they're at the trend line, especially when they're under these moving averages. So I do think the stock could go lower. You can see it was 476 just late 2023. And this is when I started buying the stock. And I've been adding recently here. We circled this yellow circle before it happened. We said it was going to come maybe down back in these ranges around this trend line. So I like this stock, $5.50 or lower, DCA, but my preference is below $5 in the fours. This next stock will probably ruffle some feathers. It's kind of one of those love-hate stocks. This is a unique opportunity because it has recurring revenue with a dividend and it's profitable. Any guesses? Look at this.
Look at this.
This is from a short report, and it was when the market was much higher. Pay attention to the very bottom, Paycom. At the time of this short report, that EV EBITDA was 51.3x. Now, if you shorted the stock, you made a lot of money. Can you guess what that multiple is today? On the 12 months trailing, 19.33x, and the forward is 13.41. So we always care about where a stock's headed, not necessarily where it's been. And if you look at some of these metrics, for example, like the PE ratio, this is pretty attractive, especially when you consider this is SaaS and has recurring revenue. And to top it all off, it pays a dividend. Now, there certainly are risks, and we've talked about PERI and how it can cannibalize existing products. But there's one thing that not a lot of people are talking about. This information's not that old. It's only about a month old. Paycom expands automated payroll with PERI into the United Kingdom. Now, in 2023, Paycom expanded into Canada and Mexico. And on the earnings call, Paycom talked about how they delivered a lot of innovation on the international front in 2023, launched our global HCM product, and now companies of all sizes, now remember, this is SMB focused, trying to get more into larger accounts, enterprise. Companies of all sizes use this product across 180 countries and in 15 languages. Now, Paycom's been pretty aggressive in the past, saying things like they've only penetrated 5% of their total addressable market in the US. Now, of course, expanding globally is going to expand the TAM, according to management, by 50%. Now, these are 12-month price targets, and you never buy off analyst price targets, but to give you a pulse, lowest price target 165, highest 250, and the average is 190. Now, that might not look exciting because it's only about a 12% upside, and we're in a bull market. But if you're looking for a DGIF type play, a total growth play that has a dividend, and you're looking for something that's maybe not crazy expensive in this market, it could be an opportunity to accumulate shares if you're a long-term investor. Looking at a chart quick, when this gap down happened, we drew this up and said you'd probably see it retest. So it got down here to $146, and then it bounced off that. And I told the gang in Discord, be careful. It's probably going to give some of that back. I circled this yellow circle and said, probably you'll see it in this area. So I've been adding to this recently, $175 or less, DCA. And one thing to note right out of the gates with this company is it's based in Israel. Now, I don't think that's a bad thing, but the stock market, for whatever reason, gives lower premiums to companies that are based in Israel. It's just a fact. Now, a lot of you probably own the Trade Desk, ticker TTD. That's going to be focused on the secular growth trend of digital advertising. Now, Trade Desk is going to be best of breed, and it's my favorite pick in this space. In fact, we've covered it on this channel since 2019. So if you're an individual investor trying to get an edge on the market and videos like this are helpful, make sure you subscribe to the channel and click that bell for notifications. But if you're looking for an alternative that's less expensive, this could be something to explore. Connected TV or CTV has a 15% compound annual growth rate. You can see on your screen expected to grow through the next several years. Retail media ad spending, 24% compound annual growth rate. Perion also has APS integration, so Amazon Publisher Services integration. And you'll notice this is not a hyper growth company by any means, but it's profitable. And if if you look at the valuation, it seems very attractive. So you're talking about some pretty solid growth here, about 15% forward revenue growth. The valuation's where it seems too good to be true. I mean, you look at the gap, TTM 9.53, forward 8.74, and the PEG gap is 0.7, and on a forward basis, only 0.31. What am I missing? Now, the gross profit margins aren't as high as I would like at 36.5%, but overall in Seeking Alpha, it gets an A- for profitability, and it's making $266,000 net income per employee. Now, when you're doing your research and picking stocks, you care about what happens next. And past performance doesn't guarantee future results. But one thing to note here, this stock has been on the market public since February of 2006, and it's trading 8.4% lower today than it was almost 20 years ago. So can it be a turnaround story is the question. Let me show you a chart real quick and the price target. So this stock was almost $43 back in April of 2023. You can see it's fallen off a cliff and it has this huge gap down. So similar to other charts we looked at today, we circled this a couple weeks back and said, here's where it could drift to. And that circle really is $20 to $22 in that range. And it certainly could go lower. The S3 is around $17 and change. So even though the metrics are there in terms of the financials, that quantitative analysis, when doing your qualitative analysis, it has a great story. But if you look at the sum of all parts, it makes it feel a little bit risky, like there's something missed. Therefore, I consider this a spec stock. I wouldn't go too heavy on it. I think it could be a turnaround play. There's lots of total addressable market to capitalize on. And I've been nibbling this stock $23 or less DCA. Now, if you're looking for a way to play some of these secular growth trends, or say you're a new investor and you're not exactly sure what stocks you want to buy, check out this video I did last week, top 7 growth ETFs to buy. One of the ETFs on the list, seriously, if we were creating a fired up wealth portfolio ETF, it'd be very similar to this one. The ticker is SPRX. If you want to learn more about that, click the card above. I'm also watching 2 other stocks really closely. The first one is Rocket Lab, especially if it gets back in the 3s. I already own some shares. I'd like to add more. And if you want to learn more about Rocket Lab, click the card above. This video goes into much more detail about the company. And the last one I'm watching closely, really I'm researching it more with the community in Discord. And if you want that information, the best way is going to be to join our Discord community, because there's a ton of DD. There's information in there that I can't explain in a quick video on YouTube. And the question with it, is it a value play or a value trap with that 6% dividend yield? And the ticker is PFE. Pfizer. If you want to do me a favor, if I added any value to you at all today, make sure you're subscribed, drop a like, and drop me a comment. Let me know what stocks you're buying now.